All right, everybody, welcome back to Alternative Finance. My name is Alex, and today we are continuing down our Investing 101 series. So, hopefully, you are here for that. And without further ado, we're going to move into today's topic. So, today we are covering bonds. We talked about interests a few days ago. If you haven't seen that video, I encourage you to go ahead and do that so you can get an idea of how interest works. And today we're going to talk about bonds, which are one of the types of investments that pay interest and one of the main ones that we're going to use in our portfolios for building a diversified portfolio. So today we're talking about bonds. So sit back, relax, and without further ado, here we go. So first things first, what is a bond? Let's go ahead and read through this definition together. Basically, it is a loan that investors make to a government or corporation in exchange for regular interest payments and the return of their principal amount at maturity. It's a way for entities to raise money while offering investors a relatively stable source of income. So basically, an entity of some kind is going to put feelers out there for investors to be able to loan them money. You are going to do that. You're going to make an investment into this entity. They're going to use your money for whatever they're going to use it for, and then they are going to pay you interest over the course of that bond, over the course of that loan, and then at the end of the loan, at an agreed upon time, which you'll know before you buy the bond, they will presumably pay you back your principal as long as nothing funny happens, which we'll kind of talk about here in a second. So that's what a bond is. How does a bond work? Because that's what I care about, right? This is for my portfolio. It's great what it is. What does it do for me? Well, first, let's talk about the different components of a bond. So first you have the issuer. So who is the person, or the entity, I should say, who is the entity that is collecting the money here? Who is putting out the need for a loan? Who is it? It could be a government, could be a municipality, so like a state or local entity. It could be a corporation, like a big business to fund project or operations. So yeah, could be a couple different types of organizations, but they're all essentially trying to accomplish the same thing. Taking money for a project or a purpose that they can then repay that back later. Next up, we got the interest rate, which is also known as the coupon. So that is going to be the actual payment that you can expect as a bond holder. It is going to be paid in what's called interest, like we've talked about before, and it is typically fixed, right? So it's not going to be a variable, different interest rate kind of changing as it goes. Usually you know the interest rate that you are going to receive on your investment right out the gate when you purchase a bond. Most bonds pay interest 2 times per year, so that is significant. So a lot of times with bank products and things like that, you will get interest every single month. With a bond, usually it accrues, and then every 6 months they pay it out. There is some exceptions to that, but that's generally how it works with bonds. Next up, we got the maturity date. So this is the date in the future that the bondholder gets back their initial investment. Now, that could be as short as a few years to as long as 20, 30, possibly even more years than that. A lot of these bonds are designed to be longer term investments that provide stable income over a longer period of time and give the entity that took the money in the first place enough time to put that money to work, recoup, and then pay it back in a reasonable time, right? So this can be a very, very long time with some of these bonds, and a lot of times that actually is what you're going for, right? You want to lock in that predictable income for a longer period of time. Now, you might be thinking to yourself, what if I need the money in the interim? What if I need that money? Well, absolutely, bonds can be sold at market value throughout their lifespan, right? So you will be at the mercy of the market, and we'll talk a little bit about what affects bond prices and what that might mean, what kind of price you may be able to expect when you do that. But if you hold it all the way to maturity, so that date that you agreed upon at the beginning, if you hold it all the way to maturity, you're going to get your principal back, and you're going to get the full amount back to you, assuming, again, nothing wonky happens. Real quick, I want to touch on another date that could be of significance. Some bonds do issue what's called a call date. So essentially, that is the ability for the company to pull the bond back early. Again, when you buy a bond, usually it will tell you right on the face of the bond, here's the maturity date. If it has a call date, this is that date. And generally, you can expect that to happen if interest rates have gone down from the time that your bond was issued. And if you think about that, right, essentially if they're paying you a certain interest rate, and right now current interest rates are lower, essentially what they will utilize that call date to do, the entity, what they will utilize that call date to do is to refinance their debt, right? So basically, They loaned out money to you at a certain interest rate. Rates have come down. When that date comes, they can basically put out a new bond at a lower rate, use that to pay you back, and now they're paying lower interest to somebody else. So significance, not always, but can be. Finally, credit rating. This is always going to be significant. So credit rating is how you are going to determine how safe is my bond investment. So usually you will have a credit rating to indicate the issuer's credit worthiness, essentially how likely they are to repay the debt on time. There are several different rating agencies that spend lots and lots of money into coming up with these ratings, and they evaluate their stability and assign ratings to help everybody else gauge the risk. Now, what are those ratings looking like? We're not going to dive too much into it, but essentially when you look at bond ratings, you're going to be looking at either AAA, AA, single A, triple B, double B, single B. Now, for your purposes, all you really need to know is anything triple B and above. So anything above that line is what's typically known as an investment grade bond. So generally a little bit more likely to be able to pay you back, less likely to encounter financial hardships, things like that. Anything below the line, below that double B and lower, would generally be what you refer to as junk bonds or high yield bonds or non-investment grade bonds. Those will generally pay higher interest, but there is a higher likelihood that something may happen which causes them to not be able to pay back the loan in full. So what are some common risks with bonds? First and foremost, interest rate risk, right? And we'll touch on that here in just 1 second on what that really means. Number two is going to be credit risk. So that's the company's inability to pay you back the amount that you loan them, whether they go through financial hardship or whatever the case may be. That is where the credit rating is going to come into play, because it will kind of give you a forward look into what the odds, so to speak, of having issues with credit risk might be. Next up is inflation risk. So what does that mean? That is the risk that whatever your bond is paying, prices will go up faster than that. So for example, if your bond pays 4% interest and inflation is going up at a rate of 5%, inflation at a rate of 5%, prices will be presumably going up faster than what you're earning. So that is a risk right there. And finally, call risk. We kind of talked about a company's decision to call a bond, right? If they do call that bond, now you're left needing to reinvest that money. It is a risk to kind of mess you up a little bit if you were banking on that interest for the long haul. So let's circle back around and take a look at interest rate risk, because that's what I really want to touch on really quickly. We'll go into more detail in this in another video, but I do want to touch on what interest rate risk is as it pertains to bonds. So basically, if interest rates change, let's think about this. You bought your bond. It pays 3%, 4%, whatever. Bond rates go up. Now they're paying 5%. If you go to sell your bond that's paying 3 or 4%, but I can go and get a bond today at 5%, it stands to reason that an investor is not going to pay me 100% of what I put into it for my bond. Why would they do that when they can go and get a brand new bond at a higher interest rate? Likewise, if rates have gone down, someone might be willing to pay me more than what I paid for it, because now the rate that I have is higher than what they could go get on the open market today. So that risk right there is going to definitely come into play should you need to liquidate the bond along the way. The market value that I mentioned when I said that you can sell the bond along the way at the market value, a lot of times that's going to be dictated by what is going on with interest rates. So I want to take a moment to mention that so that you understand along the timeline, this is probably going to be your biggest risk, aside from credit risk and something happening with the company that you actually are invested in. All right, so why would you own bonds? What is the advantage to them in your portfolio? Number one, stability and risk management. So bonds are generally less volatile than stocks, providing a steady stream of income. They help balance risk, especially in uncertain markets. And when stocks look bleak, it's common for investors to turn to high quality bonds. So if you are looking to manage your risk, generally speaking, bonds tend to be more stable in price. They're not going to move as much as stocks would. And especially when stocks start to get really volatile and look kind of crazy, a lot of times big time investors or investors in general will tend to turn away from stocks and move into something that is a little more safer, that they can predict a little bit better, which leaves bonds being a place they look pretty commonly. Number 2 is predictable income. So most bonds pay regular interest, also called the coupon, making them attractive to retirees or anyone who's really needing consistent cash flow. This can also contribute to the stability and risk management, right? So first part of that, if you are retired or you are living on a fixed budget of any kind, bonds can be a really useful tool because they pay you an interest, which is fixed. So as long as you're receiving that income and you can live on that income, it stands to reason that it really should not matter so much what's happening to the principal value of that bond, right? Because as long as my income continues to come in, I am good. That can also be a huge advantage, like I said in the second part of this, to the risk management part of it, right? So ultimately, as that predictable income is coming in, if stocks should be falling or my portfolio should be losing, that predictable income will offset some of that losses and really be able to pad my portfolio in times like that. And then on the flip side, pad those gains and increase those gains if they should be there. So number 3, we kind of already touched on this, and you kind of already saw a couple ways I just talked about that this kind of comes into play, but diversification, right? Bonds typically do not act like stocks. When one is doing one thing, the other is not necessarily doing that same thing. So that makes it a very, very healthy diversification tool to offset some of the risk we might see from something like stocks and equities. And finally, in addition to being able to do predictable income and provide that stability, a lot of bonds provide tax benefits, right? So I don't want to go into too much detail today about the specifics of that. I promise you we will make a video covering that. But for today's purposes, all I really want you to know is that when it comes to bonds, let's go down the line here. Corporate bonds, they're basically going to be like your bank products. They're going to pay you interest, fully taxable, nothing special other than the interest might be a little bit higher than what you expect from the bank products for the risk you're going to take. Now let's move to treasury bonds. Treasury bonds. You do not pay state income taxes on treasury bonds. So you will pay federal income taxes, but not state income taxes. So if you live in a state where there is state income tax, you do get a benefit for investing in treasury bonds that you do not have to pay that state income tax. Now, if you live in Florida like me, not so much of an advantage for treasuries because we don't have state income tax, but still a huge advantage if you live in a state that does. And now finally, we can move down to municipal bonds, which again is your local, state, city governments, things like that. Those have the potential to actually pay you out tax-free. Whoa, what do I mean by that? Well, all municipal bonds are going to be exempt from federal income taxes, which is a huge advantage to municipal bonds. And you might even be exempt from state income tax if you purchase a municipal bond for the state you live in. So for example, if I live in New York and I purchase a New York City bond, that bond would also be exempt from state income taxes, New York state income taxes, in addition to the federal income taxes. So again, if you live in Florida, you don't necessarily need that, like I said, to worry about that because we don't have state income taxes. So if you live in Florida, you really can invest in any municipal bond you want, and it would be tax-free because you're not paying that federal tax, and there is no state income tax here in this state. So stopping all that right there, the main point is there are some tax benefits potentially for investing in bonds. With that, if you're looking for personalized advice, always consult a financial professional. And if you like this video, please like it. Feel free to leave a comment, subscribe to the channel. We are going strong on our Investing 101 series. So if you're liking what you see here and you want to keep up with that, please make sure you subscribe so you can keep in tune with the channel and you'll get a notification when those videos go up. And until next time, you guys, that's Finance AF.